Hello and welcome back. In our last session, we got your investment plan all mapped out. Today, we are diving straight into the heart of it all, the engine that makes everything run, the stock market.
That's right. Welcome to Class 4. It is so good to have you with us as we tackle one of the biggest, most talked about parts of the entire financial world.
You hear about it all the time on the news, right? The market's up, the market's down. But what are they actually talking about? What is this giant global thing we call the stock market, really?
Well, you're in the right place, because that's exactly what we're going to break down. We're going to cover what it is, how it actually works, and why it matters so much. Oh, and you'll definitely want to stick around to the very end, because I've got a little challenge question for you to see what you've learned. All right, let's do this.
Okay, first things first. Before we get into the crazy ups and downs, we need to get a handle on the absolute basics. What even is this market, and what's being traded?
At its heart, the stock market is just a huge global marketplace. But instead of fruits and vegetables, people are buying and selling tiny pieces of ownership in companies. And it's not some big building somewhere. It's a massive electronic network connecting buyers and sellers all over the world.
And the things being bought and sold, those are called shares, or sometimes stocks. And a share is literally what it sounds like, a small piece of ownership in a business. So if a big company is broken up into, say, 1 million shares, and you buy just one, you officially own 1/1,000,000th of that company. You're a part owner.
So why would you want to own this tiny slice of a company? Well, there are two main ways you can make money from it. First, you can earn dividends. That's when the company does well and decides to share some of its profits with its owners. That's you. And second, you can earn what are called capital gains. That's the profit you make if the share becomes more valuable and you sell it for a higher price than you bought it for.
Let's make this super clear with a quick example. Imagine you buy one share of a company like Microsoft for $100. A year goes by, and the company does really well, so the share price goes up to $120. On top of that, they pay you a $2 dividend. So you've got a $20 gain from the price increase plus $2 from the dividend. Your total profit? $22. Not bad.
Okay, so we know what shares are, but where do they even come from? I mean, how does a company go from being a private business to having its shares traded by millions of people? Well, that brings us to something called an IPO.
An IPO stands for Initial Public Offering, and it's exactly what it sounds like. It's the very first time a private company offers its shares for sale to the general public. And the number one reason they do this? To raise a whole lot of money, or capital, to expand their business.
Let's imagine a company called Green Tech Energy. They want to build new factories, but they need cash, so they decide to have an IPO. They offer 10 million shares to the public at $10 a share. Boom! Just like that, they've raised $100 million. And now, those 10 million shares are out in the wild, ready to be bought and sold on the stock market.
And this is where it gets really interesting. Because once those shares are on the market, their price doesn't just sit at $10. Oh no! It starts changing, sometimes every single second. So, what makes the price of a share go up and down?
It all boils down to one of the oldest rules in the book: supply and demand. It's actually really simple. If way more people want to buy a share than sell it, that's high demand, and the price gets pushed up. But if more people are trying to sell a share than buy it, that's high supply, and the price gets pulled down. That's it. That's the engine.
So the real question is, what makes people suddenly want to buy or sell? Well, it's a bunch of things. A company releasing a fantastic earnings report. That'll create a ton of buyers. Good news about the economy as a whole. That can lift all boats. Even a decision about interest rates can make stocks look more or less appealing. And sometimes it's just about mood, the overall feeling of fear or excitement in the market.
All right, we've got the basics of a single stock down, but there are thousands of companies out there. So let's zoom out and look at the bigger picture. How do we make sense of the market as a whole?
One of the most important concepts is called market capitalization, or just market cap for short. It's basically the total price tag of a company on the stock market. All you do is take the current price of one share and multiply it by the total number of shares that exist. It's a really quick way to see how big a company is.
And we usually sort companies into different buckets based on their market cap. You've got your large caps. These are the huge, stable, well-known companies. Then there are the small caps. They're smaller, often with more potential to grow, but they can be a bit riskier. And right in the middle, you have the mid caps, which try to give you a balance of both.
So remember when we talked about the news saying the market is up? Well, they're not talking about every single company. They're usually talking about a stock index. Think of an index like a snapshot of the market's health. It tracks a specific group of stocks,
like the S&P 500, which follows 500 of the biggest companies in the US. If the index goes up, it means that, on average, those major companies are doing well.
With all this talk of prices moving every second, it's easy to get caught up in the daily drama. But here's the most important piece of wisdom to remember. Successful investors look past all that short-term noise. They focus on the fundamentals. Is the company actually growing? Is it profitable? Because that's what drives value in the long run.
So let's do a super quick recap. The stock market is just a place to trade ownership in companies. A share, that's your little piece of ownership. Prices move because of supply and demand. A company's real performance is what matters long term, and indexes, they help us track the overall health of the market. Got it? Good.
All right, you made it. Time for that challenge I promised. Let's see if you were paying attention to capital gains and dividends. Here it is. You buy 100 shares of a stock for $20 each. The share price then rises to $25. During that time, the company also pays you a $1 dividend for every share you own. So, what is your total profit?
Go on, take a second. Think about the 2 different ways you made money there. Feel free to pause and do the math. Thanks so much for joining Class 4. We'll see you in the next one.